Imagine managing a balance sheet of over $14 billion.
Right, which is no small feat on its own.
Yeah, exactly. But then imagine growing your business by more than 40% almost overnight.
Just massive, massive scale.
And then, right after that, suddenly discovering this flashing $63 million red flag over a block of New York City apartments.
Yeah, that's the kind of thing that keeps management awake at night.
Oh, absolutely. So today we are doing a deep dive into ConnectOne Bancorp's first quarter 2026 earnings report.
And we're pulling this directly from their official financial releases, right?
Yep, the raw data tables,
Yeah.
the management commentary, all of it. Our mission here is to really decode the actual health of a modern mid-market bank.
Which is so crucial right now.
It really is. We want to see how they're balancing this explosive post-merger scale, integrating new operational tech, and honestly navigating the incredibly treacherous waters of commercial real estate.
It is a fascinating moment to examine this specific institution, really, just because of the sheer velocity of the changes they're managing.
Hmm.
I mean, you have this intersection of massive growth from an acquisition, the rollout of automated workflows like AI into legacy banking systems.
Which we definitely need to get into later.
Oh, for sure. And then you combine that with the very physical, grounded challenges of managing interrelated credit risks in a highly regulated, unpredictable urban market.
Right. And for you listening, I mean, this is the ultimate cheat code.
Yeah, if you really want to understand how things work.
Exactly. If you want to know how money flows through the real economy, how commercial operations get funded, and how risk is actually modeled when millions of dollars are on the line, all of it, literally all of it, lives inside a bank's earnings report.
It's the raw mechanics of the market at work.
Okay, let's unpack this.
Okay.
We have to start with the sheer scale of the year-over-year numbers because, honestly, they are a little jarring.
Just a bit.
So, in the first quarter of 2025, ConnectOne reported net income available to common stockholders of $18.7 million.
Right.
But you fast forward to this quarter, Q1 of 2026, and that number is $36.3 million.
Almost double.
Literally almost double.
And, if you look at their net interest income, which is basically the core revenue generated from the spread between their loan yields and their funding costs.
The engine of the bank.
Exactly, the core engine. That increased by $43.4 million compared to the same quarter last year.
Wow.
Yeah, that is a 65.2% jump.
Mm.
I mean, growth metrics like that, they just don't materialize from, organic market share capture in a mature industry.
Right. You don't just open a few new branches and get 65% growth.
No, not at all. They are entirely driven by the structural transformation ConnectOne underwent in the middle of last year, specifically the June 2025 merger with First of Long Island Corporation, or FLIC.
FLAC, right. And that merger effectively bolted this massive new operation onto ConnectOne's existing framework.
Huge addition.
Like their average interest-earning assets increased by 42.7%.
Just wild scale.
But, I'm looking at the quarter-over-quarter comparison here, and the story gets a little more, complicated. Because despite the massive year-over-year leap, that $36.3 million in net income this quarter is actually a slight dip from the previous quarter.
From Q4.
Yeah, Q4 of 2025 sat at $38.0 million, plus they took $2.0 million in restructuring charges this quarter.
Right.
So it kind of forces the question, right? Is this bank still struggling with the friction of integrating FLIC, or is this just the natural cost of, tuning a newly expanded balance sheet? Because it feels a bit like a corporate organ transplant.
That's actually a really good analogy.
It makes the body stronger eventually, but there's this initial period of shock, right?
Yeah, but I think we have to separate the operational integration from the mathematical realities of just having a larger footprint.
Okay, fair.
Those $2.0 million in restructuring charges,
Yeah.
that actually points to aggressive post-merger efficiency rather than friction.
Really?
Yeah, because when you combine two banks, you inherit redundant software contracts.
Oh, right. Two of everything.
Exactly. Overlapping branch networks, duplicated back office roles. Taking those charges now is just the cost of permanently severing those redundancies. You do it to protect future margins.
Oh, it's a dead weight early.
Exactly. And as for the quarter-over-quarter dip in net income, well, the top-line revenue didn't actually shrink.
It didn't.
No. Net interest income actually went up by $2.2 million from the fourth quarter.
Okay, so the drag on the bottom line came from below the operating revenue.
Yes.
Ah, I see it. I'm looking at an increase in the provision for credit losses, which honestly makes sense given the macro environment.
Absolutely.
But there's also this noticeable bump in taxes. It says it's due to state and local apportionment factors.
Right, because when they absorbed FLIC, they fundamentally altered their geographical footprint in the tri-state area.
Oh, of course, new tax jurisdictions.
Exactly. That geographical shift automatically changes the blended tax rate the institution is subject to.
So it's just a permanent structural adjustment.
Yeah, it's not some temporary operational misstep. The core metric to really watch here is whether the newly expanded asset base is actually generating a superior yield.
Right, because expanding your balance sheet by 42% is only a win if the assets you acquired are actually performing.
And if your cost to fund those assets is actively being managed down.
Which naturally leads us to the bank's efficiency, right?
Yeah.
Because a massive balance sheet is completely useless if the core profit engine is stalling out.
Spot on.
So let's look at their net interest margin, the IS. According to the report, it actually widened by 12 basis points this quarter, hitting 3.39%.
Which is very strong.
And on top of that, both their annualized loan growth and deposit growth are moving at roughly 10%.
Humming along.
But wait, the math on the deposit side feels really counterintuitive here.
How so?
Well, the report explicitly states the average cost of the deposits decreased by 12 basis points.
Oh.
How does a mid-market bank aggressively grow its deposit base by 10% annualized, while simultaneously dropping the average rate it pays for that capital?
It seems like a magic trick, right?
I mean, usually buying new deposits in this rate environment requires like really aggressive promotional pricing. You have to pay up to get people to park their cash with you.
You do, but we need to decouple the yield side from the funding side to see the mechanism clearly here.
Okay.
So on the asset side, ConnectOne is benefiting heavily from loan repricing.
Meaning older loans paying off.
Exactly. The older, lower-rate loans in both their legacy portfolio and the acquired FLIC portfolio, they're steadily maturing or paying off.
Right.
And that capital is immediately being redeployed into new originations at today's significantly higher market rates.
Oh, wow. So that drives the top line yield straight up.
Yes. But the liability side, the deposit cost,
Right.
that is where the real strategic management is happening.
Because they're paying less.
Well, it isn't just about paying less for new deposits. It is about aggressively managing the mix of the deposits they already hold.
Ah, okay. I see in the tables here, they're heavily defending their non-interest-bearing demand deposits.
Yes, the checking accounts.
Yeah, it shows they still hold nearly $2.4 billion in zero-cost capital. That is a massive number.
It really is.
I mean, that acts as an incredible anchor, just dragging down their overall cost of funds.
It acts as an anchor, and on top of that, they are optimizing the FLIC deposit base they acquired.
What does that look like in practice?
Well, when you buy a bank, you acquire their customer relationships, right?
Yeah.
So the strategy involves transitioning those acquired customers into broader treasury management relationships.
Oh, so instead of just letting them sit in high-yield certificates of deposit?
Exactly. You get them into active commercial accounts. So by blending that $2.4 billion in zero-cost commercial checking accounts with a very disciplined approach to their interest-bearing accounts, they actually managed to drop the aggregate cost of funds.
That's wild.
Yeah.
So they expanded a net interest margin by 12 basis points organically.
Organically.
Without the Federal Reserve even stepping in to cut the benchmark rate.
Right, which requires just incredible pricing discipline across the entire branch network.
And, you know, pricing discipline is really only half the efficiency equation.
Oh, definitely.
Because CEO Frank Sorrentino highlighted a major operational shift in his commentary. He pointed directly to the implementation of, quote, AI workflow across the organization.
Yes, to drive productivity gains and control non-interest expenses.
Right. And it's such a compelling detail because it highlights the reality of how artificial intelligence is actually penetrating the financial sector right now.
It's not what people think it is.
Exactly. It's not flashy front-end generative AI chatbots giving mortgage advice to customers.
Right, no.
It's robotic process automation in the back office.
It is the unglamorous, heavy lifting side of AI.
Yeah.
Because mid-market banking involves an enormous amount of manual data extraction.
Like tax returns and stuff.
Yeah, pulling figures from commercial tax returns, verifying compliance documents, manually moving data from a loan origination system to a core banking system.
Oh man, just typing numbers from one screen to another.
Exactly. And by automating those specific workflows, the bank is basically decoupling its asset growth from its headcount growth.
And you can actually track the impact of that automation directly in the expense column here.
You really can.
Like, they absorbed a $1.6 million quarterly increase in salaries and employee benefits, which, is inevitable when you acquire a company the size of FLXC.
Right, you take on their people.
But because they are pushing these AI workflows to handle the expanded volume, their overall non-interest expenses are remaining remarkably controlled relative to their new asset size.
Yeah, they've managed to scale the volume of transactions running through the bank without triggering this proportional explosion in administrative bloat.
It's just textbook execution of operating leverage.
It really is. The revenue from the FLIC acquisition is scaling so much faster than the cost to service that new revenue.
Right. But, while the core engine is highly optimized, banking ultimately comes down to anticipating the moments when the machinery breaks.
Always. The most optimized margin in the world cannot outrun poorly managed credit risk.
Nope. Which brings us to the flashing red light over New York City.
The big elephant in the room.
Yeah, let's talk about it. Looking at their asset quality metrics, the 30 to 59-day delinquency numbers show a really sharp deterioration.
Yeah, it's noticeable.
At the end of 2025, loans past due in that window sat at a very controlled 0.19%.
Very normal.
But by the end of Q1 2026, that figure had spiked to 0.81%.
That's a big jump.
And the report is completely transparent about the source, which I appreciate. It says it's a single, interrelated credit relationship totaling $63.8 million.
All secured by 19 rent-regulated multifamily properties in New York City.
I mean, having $64 million tied up in past due, rent-regulated urban real estate, that sounds terrifying. Is a leak that size going to sink the ship?
Well, the concentration of that risk is precisely what makes it a critical focal point for management, obviously.
Right.
But evaluating a $64 million delinquent credit requires really looking at the structural defenses the bank has built around its portfolio.
Okay, so how do we look at it?
We have to view this through the lens of proportion and mathematical preparation.
Proportion first.
Right. So from a proportional standpoint, ConnectOne is operating a $14.2 billion balance sheet.
Wow. Yeah.
So a $63.8 million interrelated credit, while yes, substantial,
It's a lot of money.
it is, but it represents less than 0.5% of their total assets.
Oh, wow.
Yeah, so it is a highly localized fracture. It's not some systemic collapse of their underwriting standard.
Okay, that makes sense. And the mathematical preparation, I assume that's visible in the allowance for credit losses.
Yes, exactly.
Because their ACL sits at $153.1 million, which is 1.30% of their total loans receivable.
Right.
So they have heavily capitalized that reserve specifically to absorb localized shocks, like a complex New York City multifamily credit souring.
Right, the ACL is the primary defense. But the secondary defense, and this is specifically regarding the real estate acquired from FLIC, is actually far more interesting.
Oh.
Yeah. The report details $412.5 million in unpaid principal balance tied to the acquired FLIC rent-regulated portfolio.
Okay.
However, ConnectOne built a 16% offset into that specific segment.
Wait, a 16% offset. The mechanics of that are crucial to understand, right? Because it's driven by purchase accounting.
Exactly.
When ConnectOne acquired FLIC, they didn't just absorb those rent-regulated loans at their face value.
No, they didn't.
They ran a credit stress test during the acquisition. They looked at the legislative headwinds, the interest rate headwinds facing New York City multifamily properties.
Which are significant right now.
Yeah, and they marked those loans down on day one. They literally baked the anticipated risk directly into the purchase price.
That is the power of purchase accounting marks. By discounting the value of the portfolio upon acquisition, they establish this built-in buffer.
I see.
So before a default in that specific portfolio can actually start eroding ConnectOne's newly generated quarterly capital, it has to burn entirely through that 16% cushion.
Oh, wow. So it effectively quarantines the legacy risks of the bank you acquired.
Yes, ensuring that your own organic capital generation isn't just immediately consumed by someone else's past underwriting decisions.
And that quarantine effect, it's actually showing up in the broader asset quality metrics here.
How so?
Well, because despite this $64 million credit sliding into the 30 to 59-day delinquency bucket, the bank's ultimate loss metrics actually improved.
Oh, right.
Yeah, their total annualized net charge-offs, like the loans they actually deemed uncollectible and wiped off the books, entirely declined to just 8 basis points.
Which is incredibly low.
It is. And furthermore, their non-accrual loans dropped to 0.35%. and their broader category of criticized and classified assets improved to 2.26%.
See, it demonstrates that the problem really is isolated.
Right.
The overall credit quality of the portfolio is firming up, and management's proactive reserving strategy is doing exactly what it was engineered to do.
Isolating the volatility?
Isolating the volatility of specific urban real estate markets so it just doesn't infect the broader balance sheet.
Incredible. So once you contain the risk and you optimize the profit margin, the narrative naturally shifts to capital allocation.
Far ways.
How does a mid-market bank translate a stabilized, massive new balance sheet into actual value for the shareholder?
Right.
Which brings us to tangible book value per share, which is, arguably the cleanest lens through which to view a bank's fundamental worth.
It really is, because tangible book value removes all the noise of intangible assets, like goodwill.
The fuzzy math.
Exactly, the fuzzy math. It calculates the hard liquidation value of the institution's net assets. And, when an institution executes an acquisition the size of the FLIC deal, they typically pay a premium over the acquired bank's tangible book value.
Right.
And that premium is recorded as goodwill, which immediately dilutes the tangible book value per share of the combined company.
Right. The foundation takes a hit.
Yeah. And the market tolerates that initial dilution, but only with the expectation that the newly combined bank will generate capital fast enough to rebuild that lost value.
Like doing a massive renovation on a house.
Great way to put it.
The foundation looks messy for a bit, but you're rebuilding it stronger.
Right.
And ConnectOne is rebuilding that value at an aggressive pace.
They really are.
In Q1 2026, their tangible book value per share increased by 1.7% to $23.93.
Nice.
And the CEO, Frank Sorrentino, noted that they are now roughly 1/4 away from entirely eclipsing their pre-merger level of $24.16.
Rebuilding the tangible book value that quickly, that is the definitive proof of concept for an acquisition.
It validates the whole deal.
It absolutely validates the deal. It proves it wasn't just, executive empire building. It is actively generating the hard cash necessary to fill the hole that the purchase premium created.
And they are simultaneously returning capital to shareholders through multiple channels while they do it.
Yes.
Like the board declared an 8.3% increase in the common dividend, moving it to roughly 19.5 cents per share.
Very solid.
And furthermore, they repurchased 90,000 of their own shares at an average price of $26.21.
When management deploys capital to buy back stock while their tangible book value is climbing, they are sending a definitive signal to the market.
That the stock is cheap.
Exactly. They are stating mathematically that they believe the long-term franchise value of their asset generation far exceeds the current trading price.
And they're also finding highly capital-efficient ways to supplement that asset generation.
Yes, the SBS stuff.
Right. Subsequent to the end of the quarter, so in April 2026, the report notes they generated $1.1 million in gains purely from selling small business administration loans.
The SBA secondary market strategy is just a brilliant utilization of their origination platform.
How does that work exactly for people who might not know?
Sure. So when a bank originates an SBA loan, a significant portion of that principal is explicitly guaranteed by the federal government.
Right. Reducing the risk.
Dramatically reducing the risk. And investors in the secondary market are eager to buy that guaranteed portion because it offers a safe, predictable yield.
Oh, I see.
So ConnectOne can originate the loan, carve out the guaranteed segment, and just sell it to institutional buyers for an upfront cash premium.
Man, that fundamentally changes the return profile of the whole transaction.
It really does.
Because they don't have to tie up their own balance sheet capital holding that loan for its full, 20-year term.
Exactly.
They generate immediate non-interest income from the sale premium. They instantly free up their capital to go underwrite the next loan. And tell me if I'm wrong, they typically retain the servicing rights, right?
They absolutely do.
So they keep the banking relationship, they collect the servicing fees, but they offload the bulk of the balance sheet weight.
It is an incredibly efficient mechanism to juice the overall return on assets.
It's so smart.
It also demonstrates adaptability. In an environment where the yield curve and deposit costs are constantly shifting, having a reliable mechanism to generate non-interest income provides crucial revenue diversity.
Right. They aren't entirely reliant on just managing the traditional net interest margin spread to drive their bottom line.
Exactly.
So let's pull the threads of this entire machine together.
Let's do it.
We are looking at a financial institution that successfully absorbed a massive acquisition and is navigating the resulting state and local tax shifts.
Yeah.
They are expanding their core profit margins in a static rate environment through really aggressive deposit mix management and the deployment of back-office AI workflows.
Crucial point.
Right. They encountered a highly concentrated $64 million delinquency spike in New York City real estate, but they effectively neutralized the threat to their capital base through heavy reserving and incredibly disciplined purchase accounting marks.
Handled it perfectly.
And they are taking all of this operational momentum and converting it directly into shareholder value through dividend hikes, stock buybacks, and secondary market loan sales, driving their tangible book value back to pre-merger highs.
I mean, honestly, it serves as a masterclass in reading the mechanics of commercial finance.
It really does.
Because when you know how to dissect a net interest margin, how to evaluate an allowance for credit losses against an isolated delinquency, and how to track the recovery of tangible book value following an acquisition.
You possess a highly analytical framework.
Exactly. You can apply these exact same principles to evaluate the structural integrity and risk management of virtually any capital-intensive business in the market.
Just strips away the marketing and forces you to look at the math.
Nothing but the math.
But, before we wrap up, we always want to leave you, the listener, with a larger question, something that flows from the data we've analyzed today, but really pushes into uncharted territory.
Yeah, and the dynamic that demands deeper consideration here is the collision of the two distinct forces we unpacked earlier.
Okay, lay it out for us.
So ConnectOne is actively rolling out AI workflows to drive back-office efficiency and manage the massive scale of their FLIC portfolio, right?
Right.
Yet, we simultaneously observed how a single human-driven interrelated credit in the highly nuanced New York City real estate market could instantly skew delinquency metrics by $64 million.
Oh, I see where you're going with this.
Right now, that automation is confined to data processing and administrative tasks. But the inevitable trajectory of this technology is moving toward the front office.
So the transition from back office processing to actual front office underwriting.
Exactly. When these algorithms inevitably begin driving complex commercial lending decisions, a massive friction point emerges.
Wow.
Will an automated underwriting system possess the sophisticated contextual awareness required to read the shifting political winds of local rent regulation laws and identify a fragile, interrelated property portfolio before the capital is deployed? Or, because of the raw speed and scale at which AI operates, will it simply optimize the process of making multi-million-dollar miscalculations?
Just making the mistakes faster.
Precisely. It is the ultimate tension between algorithmic efficiency and the messy human realities of urban commercial real estate.
Man, that is the ultimate stress test for financial technology. Automating the back office protects the margin today, but deploying those same algorithms to manage physical, real-world risks. That could define the survivability of the bank tomorrow.
100%.
Because no matter how perfectly optimized the internal workflows become, the capital still has to be deployed into the real world.
And the real world is inherently unpredictable.
Always. Well, thank you for walking through this framework with us. For everyone listening, keep digging into the mechanics of the systems around you, and we will see you on the next deep dive.